How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you guys how do annuities work for retirement and how to avoid a lot of the most common mistakes that individuals make with assuming that an annuity product is better than what it might be displayed as or might be pitched as to an individual. So I'm going to go through a couple different topics and try to expose and then talk about some positives regarding annuities, what happened with old school annuities, and kind of what are the more of the newer school annuities, the innovations of annuities, and how someone could leverage that, for their specific retirement income needs or safe, consistent retirement growth needs. So let's get started. Basically, lifetime income and safety, not growth, is the first segment that I talk about. With an annuity contract, it's a type of contract or an account that's established through an insurance company. Insurance companies are the only ones that can offer annuities, and reason being is the way that they work is the insurance companies leverage their actuarial data showing mortality tables. So what that means is an insurance companies already are typically in the business of like a life insurance carrier, for example. An individual would purchase life insurance with that risk of dying too soon. So they would take premium dollars, pay either on a monthly basis, quarterly basis, annual basis, pay it into a plan to understand that there's going to be a lump sum death benefit that will get paid out to their beneficiary in case they did not suffice X amount of years. So with life insurance, an individual could have life insurance for their entire life, known as permanent life insurance, or they could have it for a term duration of time, meaning they're placing small premium dollars in there. And then ultimately, whenever they pass away, during that time frame that they have the coverage, that amount of money, that benefit is going to pay out a lump sum. So that was the starting concept of an annuity, is to try to figure out that life insurance aspect, but in reverse order. So what happens is typically an individual takes a lump sum dollar amount, they place it in with an insurance company, and then the insurance company is going to compute and provide lifetime income based upon what that lump sum dollar amount is. So if someone goes and has $100,000 and let's say that they're 60 years old, well, rather than guess how much money they could receive for income so that they do not outlive this money, someone might take this guess and say, okay, I'm going to try to pull out, $5,000 per year from my account. I'm going to leave it completely liquid in cash, and, this should at least last me for the next 20 years. Well, mortality rate speaking, that might be a problem, especially if you have family members that lived in their 80s. Also, technological advances are showing individuals living to 87 years old, 91 years old, depending upon if you're male or female. If you're married, well, then those statistics go up higher. So these are the different concepts on why an individual could leverage an annuity contract and say, okay, if I go to a company, I could go to the best insurance company in my particular area that's offering the top cash flow percentage, that would say, okay, $100,000, maybe they could receive $7,000 of income for the rest of their life. So that's how annuitization typically works. That's what would happen was an individual would go to an insurance company, give them a lump sum initial deposit, and then that insurance company, depending upon whatever the best one was, or a random insurance company, you might have company XYZ that is providing this person $5,000 of lifetime income, as opposed to company ABC, which is providing them $7,000 of lifetime income. So obviously, the mistake that someone would make is go with a crappier payout rate, a crappier cash flow percentage than the better company is, and that's a very, very common mistake, and that's the mistake that a lot of insurance companies try to have individuals fall victim to. They try to do their marketing pieces so that their product, their company is going to stand out in their mind, and that's where they're going to essentially receive the call. With the basic types of annuity contracts, you could leverage it specific to your age, specific to what your goal is of either immediate income, deferred income, etc. So just always be mindful of that each carrier is going to be bidding on your business, and there's going to be a handful of carriers that are going to be really good for your specific situation. Don't fall into the trap of just going into a random company. So in this example, let's say that the company, ABC is giving them a 7% cash flow, meaning a $100,000 deposit is going to give them $7,000 per year for the rest of their life. So if they live into their 80s, their 90s, their 100s, $7,000 will still be paid, to that individual each and every year, each and every month, depending upon the terms of that contract. Now, the downside to how annuitization works is this individual is surrendering all their monies. So when old-fashioned annuities, yes, they would give that person peace of mind that they could never outlive that income stream. But what do we have? We have beneficiaries. We have loved ones that we might want to leave these monies to make sure that that's maximized. And this is where the shift has taken place. This is where the innovation of income riders came into play to state, well, rather than the old sorts of annuities that $100,000 would go to the insurance company's paying $7,000. Let's say the person lives for the first year, lives for the second year, and then passes away. Well, with those old sorts of contracts, we could deduct $14,000 from the original $100,000 deposit, and $86,000 is now pure profit to the insurance company. They got to leverage this $100,000, make money off of their money, and also receive a huge net net amount off of what they didn't pay out. So this was the problem. This is where people, got frustrated. And they said, this is ridiculous. These insurance companies are making money hand over fist with this annuitization strategy. So then in the early 2000s, when you had the implementation of income riders, what they allow you to do is have somebody go to a company, maybe they're receiving, a 6.5% cash flow through the form of an income rider, with this $100,000 deposit, receive lifetime income of $6,500. But if, let's say, they live the first year, they get $6,500. Live the second year, they get $6,500. $13,000 came out of that account. That account value is now sitting at $87,000 if everything else is equal. Now, when that person passes away, the beneficiaries could receive that $87,000. They actually allow them to control that account value. So when you go and you could structure annuity contracts, you're leveraging the insurance company that utilizes their actuarial tables. They utilize the law of large numbers to be able to provide this individual lifetime income dependent upon their age and dependent upon their deposit. So the insurance company is making their calculation on the back end to then say, okay, this is our cash flow percentage. If you go and want to trigger income immediately, well, maybe we're going to give you a 6% cash flow, but if you wait 5 years, well, then we're going to give you an 11% cash flow. So the longer you wait, the longer that the insurance company could have your money before they start actually paying money off of their books. And that's why they're trying to incentivize you guys to either, if you're going to deferred income annuity or just go into immediate annuity, those are going to be different variations, different, cash flow percentages. And it's all about figuring out what the cash flow is. So the most common types of annuity products, or at least why someone wants to leverage annuities, is for that lifetime income play because they know they can't do it on their own. They don't have the law of large numbers with just themselves. They could leverage, it's just a big game of leverage. If somebody has, $500,000 in retirement savings and retirement assets, and they only need to receive, $10,000 of income, well, maybe that's only going to cost them $100,000 out of their $500,000. They don't have to leave their money at chance. They don't have to leave their money at risk with mutual funds and just hope that they could siphon out $10,000 each year from their full $500,000 account. They're segmenting a portion of it that's being purchased with an annuity contract, whether that's qualified retirement accounts such as through 401k monies into IRAs, or non-qualified money such as cash, from the sale of a business, from the sale of a home. You don't have to use your full dollar amount. You only want to use the smallest amount and only as much as necessary to accomplish that income goal. You could also have it on a safety play, meaning that, let's say if somebody likes the concept of indexing strategies where they have an IRA account that's tied to mutual funds, they have mutual fund related fees, they have advisor fees that they're paying each and every year, they're susceptible to downward market loss, and they want to eventually pull income from this account, well, you could set up specifically designed fixed index annuity contracts that allow you to eliminate the mutual fund related fees, advisor fees, downward market loss, and then anytime that the market goes up and you receive a credit into your account, you could actually leverage that credit as income for that year so that you're not dipping into your principal. So that's a way that you could do the safety. Over here, I say not growth. The biggest misconception is individuals think that they could get these astronomical rates of returns with annuities. And this is where variable annuities came into play. And I hate variable annuities because when you actually look under the hood of variable annuities, you have so many hidden fees in the prospectus, in the 300-page prospectus, that you're able to expose. I mean, I've seen as bad as 8% in fees in a given situation where you have, mutual fund related fees, you have variable annuity related fees, you have advisors still tacking on advisor fees, brokerage accounts. It's just a complete mess. And yes, you could still provide lifetime income off of those accounts through income riders, but typically it's not going to be as attractive as a newer, innovative hybrid annuities using FIAs with income riders. And that's typically what I like to talk about in my, a lot of my videos, because I just think you guys should have the most control and should really have a worst case scenario in your back pocket. Worst case scenario with a variable annuity, if it's a crappy variable annuity, you could lose all your value, you could lose all your money. There's nothing left to your beneficiaries. So when you're preparing for the worst on an FIA or with hybrid annuities that are specifically designed, well, yes, it's going to give you the potential for growth. It's also going to give you that potential for that lifetime income. Now, you're not going to get astronomical growth. You might get in a given year, you could get a double-digit gain, but typically it's going to average between 3 to 7%, depending upon how good of a contract it is. When interest rates increase, ultimately cap rates on index annuities are going to increase as well because it's tied to the 10-year treasuries. So there's a whole slew of combinations they just want to make sure, but it's not set up as a growth product. If interest rates rise, possibly it could be a good growth product, but and with this current low interest rate environment, people are seeing problems with that, and they're only getting that safe, consistent rate of return, understanding that they're not going to lose value when the market goes down, but they'll still be able to gain when the market goes up. And those specific accounts, you could set them up on a fixed interest rate known as a MYGA, like a fixed annuity, which kind of acts like a bank CD. You're giving X amount of thousands of dollars to the insurance company, and they're providing you a fixed interest rate year by year. You don't have to trigger lifetime income on those types of accounts. Just like fixed index annuities without income riders, you don't have to trigger income riders on. You don't have to trigger lifetime income on those accounts. Same thing with variable. Any sort of annuity contract, you could essentially do that with, except for like immediate if you're looking to trigger out that life-only income. So just be mindful of that. You could either attach the bells and whistles onto it, or you don't have to. You could also attach death benefit riders onto it, or you don't have to. So there's all flexibility on creating a specific plan to see whether or not it might work for your retirement or not. Now, some of the biggest problems are the misconceptions with some of these annuity contracts is regarding bonuses, guarantees, etc. What you have is these income rider accounts, and these marketing plays that these companies do are ridiculous, and it's horrible because people fall victim to it. We also have a radio show, and I constantly talk about do not get exposed to annuity contracts, to the wrong annuity contracts. All because a company's giving you a 7% guarantee on a lifetime income rider does not mean that this is actually a good contract. It could be a really piss poor, excuse my language, it could be a piss poor contract if their lifetime income, if that cash flow percentage does not check out. If you have one company that's giving you a 7% guarantee on your income rider, basically it's known as an income roll-up rate to calculate how much lifetime income, how much cash flow you're going to receive, there's many times that the 7% guarantee could actually produce less income than something as small as a 5% guarantee, because it's a combination of your income base and your withdrawal rate percentage that's going to equal your cash flow percentage at the end of the day, at the end of the year. Bonuses. Many times companies, they could give you like a 10% bonus off of your actual money, but, what's the catch? Why are they doing this for you? They're just going to be gracious and say, oh, here's all this free money and, you have full access to this money. No, there's problems regarding annuities. You have restrictions regarding annuities, meaning if you're in a 10-year contract, you're going to have, 10-year surrender charges. You're going to have some access to your monies, but typically you're going to be handcuffed into that contract for at least those next 10 years. Typically, whenever I set up annuity contracts, I say you only want to do how that plan is designed for. You don't want to try to play the game with the insurance company. If you have a goal, let's say you're 60 years old, you want to retire at age 66, well then we're going to find the best contract that's going to provide you the best either growth play or lifetime income play where you're triggering lifetime income at exactly age 66. You're not going into an annuity contract to go into it at age 60 and then trying to receive a premium bonus and then pull all your money out by age 61. The companies are smart. Companies are multi-billion-dollar corporations. They're not that stupid to realize if they give you a 10% premium bonus, you're not just going to take the money and then just cancel the contract. They're going to hit you with surrender charges, with bonus recaptures, all those different aspects. So do not just get caught up in bonuses, because a lot of times bonuses really aren't worth anything. They're more fluff than anything. It's more of a teaser to get somebody into a product, just to basically, use their monies against them and restrict their access and restrict the actual benefits of that specific contract. Guarantees, once again, how to look under the hood and see whether or not a contract is good with specific guarantees or not. Don't just get caught up in the 7% guaranteed number, the 5% guaranteed number, because most likely there's more to that story, more to why the insurance company is trying to give you this offer. Insurance companies are not nice. They're able to, they're going out there for their own benefit. One of the points that I always try to make is, you could leverage if you have about 1,200 different scenarios on average with like this individual that's age 60 that's looking to retire at age 66. Well, he might have 1,200 different products, recommendations, strategies that come back. Off of those 1,200, maybe 95% of them are complete garbage. And that means that the insurance companies are just trying to use that person's money against them. So that's why with that 5% that are good offerings, how exactly can you designate, how can you sift through, 100% of these 1,200 different products and strategies, making sure that you have, option one, option two, option three, to make sure that it's going to really be great for your situation. And that's what we try to do, is really expose the bad companies, show you which carriers are really good. We're an independent agency, so we're not going to be biased towards one company over the next. It's going to be whatever one comes back, as long as it's a good standing company, good indexing strategies, good customer service, different things like that. That's where our recommendations are going to, lead you guys towards. So I hope that all of that makes sense. And the last section, really briefly, as I say, segment smallest and only necessary monies. If you go and you have retirement assets, well, a lot of times individuals leverage annuity contracts because it provides contractually guaranteed income. You have something known as a legal reserve structure, making sure that if that company goes under, you have tiers of safety that could step in and make sure that those contracts are safe, that those monies are safe, that everything is abiding by that contractual guarantee. With that being said, you have restrictions with annuities. You have cap rates. You have surrender charges. You have all these different aspects where you only want to leverage the smallest amount of dollars and only as much as necessary for your goal. So if we understand that you have an income need in retirement and you have a gap of $20,000, but yet you have 600,000 of retirement assets, don't take the full 600 and throw it into a product. No, you want to take the smallest amount of monies out of that 600. Maybe that's going to require $200,000 that you're placing into a product specific with an annuity that's going to provide you that lifetime income of $20,000. Now you have 400,000 left over. Maybe 200,000 you could segment into emergency funds, into your fund money, and the other 200 you could utilize in speculation. You could utilize in alternative investments, in mutual funds, in stocks, bonds, whatever your preference is. But what you're not doing is you're not leveraging all your chips into that one basket. Yes, you could receive lifetime income and it could be maximized, but at the end of the day, if you don't need the income, there's no need to go into those restrictions. You only want to place what's necessary, for your specific plan. So if you found value in this video, please feel free to give us a call. We offer 24/7 customer service. So you can give us a call mornings, nights, weekends, 1-800-566-1002. We have specialists standing by. And the first and foremost, I guess the most important aspect is to make sure that you're not being trapped into an annuity contract. Like I said, on average, we go through over 1,200 different product scenarios, strategies before we give our top 3 recommendations. This is something known as our proprietary Retire Sharp planning system that we have through a Fossey Financial Group. Hence the name of our website's retiresharp.com. Hence, want to keep it with that RPS system to make sure that you guys are getting the absolute, for any dollar you're placing into these contracts, you're getting the absolute best, best leverage or best leveraging piece out of it. So with that being said, there's many times annuities are not correct for an individual situation. And that's what we try to do, is we try to let you know whether you can leverage an annuity. If you want to know the intricate details of it, we have access to every carrier in your particular area. So we work on a national basis, and we are A+ rated on the Better Business Bureau. It's because we try to give very honest feedback and educate you guys. We have a lot of free reports, free ebooks to help you guys get further acclimated. We create personalized reports, personalized videos for you guys, so that you guys could really understand what you have, what you need, and we'll be there to try to help you out. So I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.